If you own a rental property, you've probably asked yourself this question. Should you list it on Airbnb or go the traditional route with a long-term tenant? By the end of this video, you'll know exactly which strategy makes more financial sense for your specific situation. And I mean actual numbers, not vague advice. And stick around because the third point I'm going to share might completely change how you think about this whole thing. So grab a coffee. Let's talk money. Here's the deal. Both strategies can work. Both can lose money. The difference comes down to three factors: your local market, how much time you have, and what your actual profit looks like after all the costs nobody talks about. I'm going to break all three down, give you real numbers, and by the end, you'll have a clear answer for your property. Point one: long-term rentals are the quiet moneymakers. Here's what I mean. When you sign a 12-month lease, that tenant pays you every single month, rain or shine. You don't lift a finger between lease renewals. Your income is predictable. Your calendar is clear. According to ATTOM Data Solutions, which tracks real estate trends across the country, the average annual return on long-term rental properties in 2022 was around 7 to 9% of the property's value. For a $300,000 home, that's roughly $21,000 to $27,000 per year before expenses. After mortgage, taxes, insurance, and maintenance, most investors pocket somewhere between 5 and 8% net. Now here's the part nobody emphasizes enough. Long-term rental vacancy is typically just 1 to 2 months when a tenant moves out. That's it. You list the place, you screen applicants, you lease it again. 2 months of lost rent every year or two is built into the math, and it's totally manageable. My friend Carlos had a condo in Phoenix. He rented it long-term for $1,800 a month. His tenant stayed 4 years straight. Zero turnover costs. Zero cleaning bills. 03 AM messages about broken dishwashers. He made over $86,000 in that 4-year span with minimal hassle. That's point one. Stable income, low management, predictable returns. It works, and it works well. But now here's where it gets interesting. Point two, Airbnb can crush those numbers in the right market. I'm talking annual revenues that would make a long-term landlord's head spin. According to a 2023 report from AirDNA, which analyzes short-term rental data, the average Airbnb host in the United States earned roughly $14,800 per year from their listing, but that average includes people who list once a month and barely try. In top-performing markets like Destin, Florida, or Gatlinburg, Tennessee, hosts are pulling in $40,000 to $60,000 annually. Let me give you a real example. Sarah owns a beachside cottage in Orange Beach, Alabama. She charges $220 per night. During peak summer months, she books 20 to 25 nights easily. That's $4,000 to $5,000 in a single month. Her long-term rental comp in that neighborhood, $1,500 per month. She makes 3 times as much during summer alone. The math seems obvious, right? Airbnb wins, except it doesn't always work out that way. And that's what brings us to the third point. If this is clicking for you, hit subscribe. I drop videos like this every week, and the next part is where most people get surprised. All right, here it is. The real answer to which makes more money comes down to net profit after costs. And this is where Airbnb gets absolutely destroyed in most scenarios. Here's what Airbnb hosts consistently underestimate. First, there's the platform fee. Airbnb charges hosts around 3% per booking, but that's just the start. You're also paying cleaning fees after every single guest. In 2023, the average cleaning fee for a short-term rental nationally was $120 to $150 per turnover. If you host 40 different groups in a year, that's $6,000 just in cleaning. Second, your utilities are way higher. Long-term tenants pay their own electric and internet. With short-term guests running the AC 24/7 and leaving lights on, your utility bills can jump 30 to 40%. And then there's the big one, occupancy rate. This is where people get burned. That $14,800 average I mentioned earlier, it assumes hosts are actually booking their properties. The national average occupancy rate for Airbnb listings in 2023 was around 57% according to AirDNA data. That means nearly half the year, your property is sitting empty, generating zero income but still costing you in mortgage, taxes, insurance, and upkeep. A study by the real estate platform Zillow found that in over 60% of major U.S. markets, long-term rentals actually generated higher total annual income than short-term rentals once you factored in all these hidden costs. Let that sink in for a second. In most places, the traditional landlord wins. So, which is it? Airbnb or long-term rental? Here's my honest answer. It depends entirely on 3 things. 1, your market. If you're in a high-demand tourist destination with strong year-round booking potential, Airbnb probably wins. Cities like Orlando, Denver, or coastal vacation spots. 2, your time. Are you willing to manage guest communications, coordinate cleanings, handle reviews, and deal with the occasional nightmare guest? If not, long term is the obvious choice. And three, your costs. Run the actual numbers. Take your potential nightly rate, multiply by realistic occupancy, subtract platform fees, cleaning, utilities, and maintenance. Compare that to your long term rental income after mortgage and expenses. The spreadsheet doesn't lie. Look, I get it. The idea of earning $40,000 on Airbnb sounds incredible. And for some of you, it absolutely is the right move. But for most property owners in most markets, the simplicity and reliability of a long term tenant quietly wins. Sometimes the boring answer is the correct one. If you found this useful, smash that subscribe button. Share it with someone who's trying to decide what to do with their rental property. And if you want more videos breaking down real estate investing, real numbers, and no fluff, you're in the right place. See you in the next one.